numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. The numbers make sense. Jeb shows a vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Welcome to another week of the Educated Home Buyer Live. That was once again our AI-generated song. We wanted to play it again because we thought you guys probably missed it last week, and you missed it. And for that, you should hear it. And
Jeb,
so here we are.
They couldn't miss it. It's a hit. It's on the airwaves. People are requesting it. You can't get away from it. Actually, it's the song of the summer.
There we go. So it is Wednesday. It is time for our live to answer your mortgage and real estate questions, update you on the economy, and just help navigate the home buying process, if you will. A lot of positive things happening in the world of real estate and mortgage, and not huge changes, but one of the big things is the Fed may cut rates as early as July, and we're going to talk about that tonight. Some of the changes that's happening out there, how it's also impacting mortgage rates at the moment. We've gotten some positive news on that front. Before we dive into it, Josh, what's new for the week?
What's new, Jeb, is that our president may just name a new Fed chair like now, even though he doesn't really get to put him in place till next year.
Lame duck Fed chair.
Just do it now and just kneecap this guy that thinks he's calling the shots.
That would be hilarious. We have a lame duck Fed chair for a year and a half before he.
Smart, Jeb. Smart.
That would be hilarious.
You're playing checkers. I'm playing chess, buddy.
There you go. And last week we're no longer streaming this to the Educated Home Buyer podcast channel. So this is just on my channel. But last week we started our new series, which is on Fridays, updating you on weekly data before we head into the weekend and guiding you through that process. A lot of you guys showed up, really good turnout on Friday. Last week we did it at 11 a.m. We're going to try to hit 11 a.m. again this Friday to keep it consistent. So if you want more data, you want more information, we got a couple of things coming out this week. PCE, jobless claims. We're going to prep you on inventory right before the weekend starts, just so you have all the ammunition you need to be able to make insightful offers as you head into the weekend. So it's that time of the show where we start going over charts, as we always do, to help guide you through that process. So what we're going to do here, Mr. Josh, is we're going to pop this up. And we're going to start with inventory. So inventory, we did see a rise this week. It's continued. We're up 31% more inventory this last year. But the increase that we saw this week was just over 3,000 homes. Not the kind of jump you want to see. So that doesn't necessarily mean we're stalling out, but it's not the growth that we've seen over the last couple of months. This time last year, we were sitting around 634,000 homes. So that's where that 31% increase is coming in. Huntington Beach and Orange County. So Orange County is still seeing more inventory come to the market, up 2.82% week over week. That's 4,893 homes on the market. Huntington Beach actually saw a decrease by one home week over week, and sitting just under 0.36% down week over week. So nothing too much to worry about there. Again, the last couple of years, we really haven't seen the seasonal peak until between September and like November. So it'll be interesting to see how this year plays out, because prior to the pandemic, we would see that drop off sooner than later. And I think there's an opportunity, if rates move lower, you see inventory probably drop quicker than you would otherwise. But it's something we will continue to monitor and pay attention to. So new listings data this week, 76,000 versus 71,000 last week. And just again, for context, back during the years of the housing bubble, we were seeing 250,000 to 400,000 per week. So significantly below those levels, and also below where we were back in 2022, which obviously was prior to mortgage rates shooting up at that point. So that's, you can kind of see from that chart there.
Even
what was
2022,
happening.
Jeb, you look at it, it was
Sure.
that May, June, July, when rates spiked, there was a group of sellers that panicked, or wannabe
Sure.
sellers that say, oh God, the window's closing, I better head for the exits. And then you look, that gray line kind of falls in line with 24, 23, 25 after that, or 25, we're not there yet, but 23 and 24 looked a lot like 2022 for the second half of the year.
Yeah, and you can kind of see some of the dips in there. My guess is those are probably holiday related dips, and something that we see annually. But we'll continue to monitor that as we look at weekly pending sales. So last week's data showed year over year growth in our weekly pending sales, 70,352 versus 67,000 last year. So again, more homes going under contract this year than last year, even if rates, where I don't know where rates are exactly today, 6.75-ish. I'm sure, Josh, somewhere in that ballpark, maybe potentially lower, which we're going to take a look at. But again, more activity this year than last, even with, subdued demand. Total pending sales, 405 versus 396. There's basically the idea here is that the seasonal peak period is likely over, and the seasonal decline in the data has begun. But I don't know. Based on historically speaking, looking at that chart, it looks like that would probably be the case. But I'm not ready to throw in the towel yet on
rate dependent. I say rate dependent,
and that's why I'm not ready to fold quite yet. Percent of properties with price reductions sitting at 40%. Again, a little bit tick up over where we were last year. And you're seeing it out there in the market. Homes are sitting longer, and sellers are having to do things in order to get those properties sold. Now, when we look at mortgage application data, where are we on mortgage application data, Josh? So I think this past week we were flawed. No, this shows a decline. So
it was down week over week, but I threw this chart. It was either this chart or a similar chart here in later in this, and the entire point was, and I'm not sure what your data is on this, because I've got the same chart and it shows flat across week after week. I think
I thought it was flat week over week too. And
you're 1 week out of date with this one. I have the flat one in here later, but the whole reason why I threw it in there is it's up year over year. And if we show, if we threw in 20 and 2021, it's massively down. But everyone's like, oh my God, no one can afford, no one's applying. The purchase index is up. It's better than it was last year, despite the fact that affordability is 100% strained, and everyone is wondering when in the world interest rates are going to cooperate and improve affordability.
And something we talk about not as often as we used to, but the spread between the 30-year and the 10-year, you can see from this chart here, just under 2.5%, 2.4-ish, somewhere in that ballpark. But considerably better than when we were 2024, 2023, especially 2023, when we saw that 8% mortgage rate in October of that year. So that's improving. In theory, that will continue to improve with economic data coming out, and that could allow interest rates to come down without the Fed actually doing some sort of rate cut. Schiller, Josh. So this is one where we're still seeing an annual increase, 2.7%, I believe, annually from Case Shiller, but we do have a month-over-month decline, just under one. I think it's 0.51% down month-over-month. So, homes aren't appreciating like they were. The reason we're still seeing that positive growth is because of how they aggregate the data and it's annualized. So my guess is you'll continue to see these month over month numbers probably come in under. They'll probably likely negative for the foreseeable future until you see a change with mortgage rates.
Well, this chart comes from Bill McBride over at Calculated Risk, and in the article that goes along with this for subscribers, he said at the current pace he expects by the end of the year-over-year numbers will be negative. He's very good with the data, and so I don't doubt that to be true, with a giant but. The cloud over everything is what happens with the economy, what happens with unemployment, what happens with inflation, therefore what happens with interest rates. If interest rates drop and moderate closer to that 6% range, we will not go negative before the end of the year. If they stay 6, 7, 5 and above, probably the path that we're on.
There you go. Take a look at another chart just showing year-over-year home price appreciation for May, 2.5% down from 3.2% a month ago, and then 5.4% a year ago, and back in 4.7% back in 2019, Josh. So,
and that's the American Enterprise Institute. They pull the data from ICE Technology. So ICE Technology provides loan origination systems and a bunch of other data. So they put a report together. American Enterprise Institute analyzes it. So if you're wondering, hey, how come different people have different numbers, different data sets that they're pulling from? When we look at that, this is again important. Home price appreciation varied significantly among the 60 largest metros, ranging from minus 10.3% in Cape Coral, Florida, to plus 8.1% in Louisville. We looked at last week in Cleveland. Louisville. So per someone else's data, maybe in Redfin data, Cleveland is up like 12% year over year. So definitely large variations depending on where you are in the country. The important thing, we talk about the chart of seeing appreciation moderating. It's moderating across all tiers. We talk about location being important, but also your segment of the market. If you're looking at an entry-level home, you don't really care what's happening with mansions. But what they're showing here is that appreciation is significantly lower in all price points. It's actually holding up a little bit better on the high end, which is somewhat surprising just because the activity, generally people entering the market on the lower end is where we see just a little more durability there. We already went through the applications index. Jeb, I thought this chart was very, very important or interesting at least. This is appreciation since 2022. Metros in the Northeast and Midwest experienced significantly more home price appreciation growth than metros in the South and the West. So if we look over here to the left, the areas that are down, Florida, Texas, California, Arizona, Colorado, Florida, California, Oregon, and then over on the right, it's all Northeast and Midwest. So you need to know where you are at and where the market is behaving where you are, because that's really all that matters. Don't love this chart. We're not going to even talk about it. Inflation month over month. So this is the Cleveland Fed's nowcast. We get PCE on Friday. PCE is the Fed's preferred measure. They want to see this at 2% or less year over year. The projection here is we're going to get 0.14 month over month and down to 2.58 year over year. And you're like, well, for a 0.14, that should be right at around 2%. We have that base year effect, and we're going to talk about that both for PCE and CPI. The reason why I have CPI for June highlighted up here in red is about 10 days later, we're going to get the CPI data, and we are about to run into some base year effects. So for core PCE, we have a 0.1 falling off. If we get a 0.14, they'll round that down to 0.1, and the headline won't change. If we get a 0.15, 0.16, they round it up to 0.2, and the headlines in the news are going to tell you that, oh, inflation's ticking back up. We're starting to see the impact of the tariffs. Now, on the flip side with CPI, we have a 0 falling off. And if you remember this here, a 0.25, 0.23 coming on. So tomorrow's headlines today, flash forward, and what you're going to hear when CPI gets announced is, ooh, the impacts of the tariffs are finally being felt. Might be true, but still too early to tell. That's why we like to look at Truflation here, a very high correlation to CPI. It's at 2.18. A week ago, it was at 2.12. Yesterday, 2.16. A month ago, 2.07. And a year ago, 2.42. all of those numbers are in the low twos, very, very close to what the Fed would like to see. This isn't the measure that they use, but it's a nowcast that is probably more accurate of where we are because it's integrating more accurate and reasonable rent figures than what the Fed's data does. You guys may have noticed that there's been a little bit of an international conflict over the last couple of weeks. And one of the things that many of the doom and gloomers would like to say is we're going back to 1980. We're going to have an oil crisis and inflation's going to go to the moon and it's going to cause gold to go through the roof and the dollar is going to be worth 2 pesos. And in light of that, it's important to note that today the United States supplies 22% of the world's oil. This is a very, very, very different chart than what you had in 1980. The world is less dependent on oil then, and the US is much less dependent on the world's oil. Doesn't mean it can't have an impact. It can and likely will. But as you've seen this week, it's been fairly well contained and has actually seen a reduction in oil prices this week. So in terms of inflation, all that fun stuff, what are we looking at? 75% chance of no cut next month, 88% chance of at the following meeting, which is not August, it's September, and then a 75% chance again there in October. So 50 basis point cuts sort of priced in the futures market. And right now they're already at a 90% for January of next year.
Okay, so Josh, we started the episode by talking about the Fed could cut as early as July with the idea that, Bowman and Waller, both Fed chair members, have both come out and said that they could see a cut as early as July. But basically with, I think Bowman was, she's okay with cutting as early as July. And then Waller had made a comment as well. But Fed Chair Powell, I believe in the testimony yesterday, Josh, I think it was during the testimony or outside in an interview or of some sort, basically said, hey, listen, we're waiting for inflation data to come out and see if the tariffs are having an actual impact on these numbers. And if they don't, and inflation comes in basically as expected, then there's an opportunity for a July cut. Kind of came out there and said it. At the same time, if you see inflation go up in those numbers, then I think the July cut is going to be dead. But the reality is we haven't been talking about a July cut at all, like zero chance. A month ago, he was talking about patience and waiting and let's see what happens. And now all of a sudden the potential's on the table. So I think that, I can't say that there will be, but at the same time, I think, this number could get skewed more in the favor of a rate cut if the data is friendly.
Well, we had several, there's people who are insistent these tariffs are going to be horrifically inflationary. It's going to make things very problematic and the Fed's not going to be able to cut. Rates are going to go back up, 5% treasuries, all this fun stuff. And there's been another side that has always said there is not enough heat in the economy right now to force those all onto consumers. So some of the suppliers, some of the producers, sellers, and some will fall on consumers. And it is a one-time rate increase or level increase to prices. It's not an ongoing rate increase. So what we're seeing so far is minimal impact. We wouldn't have expected to see all of the impact just yet, but minimal. Hopefully we continue to see that, and that will trend into this because Jeb, today we recorded an episode of the podcast of what does it actually mean? We saw last week, the Fed comes out and says, we're not cutting. And immediately Pulte, the FHFA president, and Trump, just, you're an idiot. Powell's a moron. He should be cutting 2 to 3% today. And would that impact mortgage rates? If they did, would we have 2% lower mortgage rates? We wouldn't. So we go through that in detail. That one is not going to be out for about 10 days, but I think it's a very good episode, and it's really important to take a look at it. We saw a study, Jeb, in a newsletter that comes out that both you and I read today. It says for every 25 basis point Fed cut, at least do about a 10 basis point reduction in the 10-year treasury. If spreads stay consistent, that would say if we get 2 cuts, mortgage rates are 20 basis points or almost 0.25% lower. When we've seen rates come down in fits and spurts over the last couple of years, we've also seen spreads narrow during that time frame. So 50 basis point cut is probably somewhere around a 25% reduction to rate, but the market doesn't wait for it. They front run it. They're looking at the same data, and we've already seen just over the last month, rates are down about 0.25%. So from that perspective, as long as it continues to show softening economy, not weak, but softening, unemployment ticking up, inflation under control, we're likely to see rates continue to improve. This little orange down channel is what we've seen over the last month. That is from 4.6 on the 10-year down to about a little under 4.35 today. That pink line is the 200-day moving average. We're under it, which is a very good thing. But if you look, the last few times we've dipped under it, we had 1, 2, 3, 4 days and then shot back above. And the last time before that, 1, 2, 3, 4, 5, 6 days below it and shot back above. You need a sustained move for 2, 3, 4 weeks under that 200-day moving average before that really becomes a trend change for us. What does it mean for actual interest rates? Mortgage News Daily is reporting 6.79, so call it 6 3/4 on a conventional loan. FHA and VA more like 6 1/4, and that's down a tiny bit day over day, about 1/8% week over week, and just like we said there, about 1/4% over the last month. So trending in the right direction. We talked about that on the live show on the Educated Homebuyer last Friday. That was our base expectation for this week. Tomorrow we get the weekly jobless claims, we get the next look at GDP, and then Friday we get PCE. So check back in on Friday. We'll give you that information on the Educated Homebuyer channel, and we'll see if Jeb and I were right with our prediction.
There you go. So just a little housekeeping. This last week, we filmed the 5 biggest mistakes we see home buyers making in this current market. It's on the podcast, both on Spotify and Apple, as well as the YouTube channel. So if you haven't done so already, make sure you check it out. Make sure you're subscribing there as well. The journey, or the goal there rather, is to help as many people become educated home buyers as possible. So we would love you to be part of that. So if you haven't subscribed, make sure you do. And with that, Josh, we got a couple of questions rolling in here, so we're going to start answering those. But while we're doing that, let us know where you're watching from. Let us know your questions. That's why we're here, to answer those. And also, let us know what you think of prime rib French dip sandwiches. Do you like them or not? Zofo in here seems to like them, so we're going to see if you like them. And we're gonna ask the question. We're gonna see if everybody's on the same page, or if there's people against. And I'll start, Josh. I'm not a prime rib French dip guy.
Well, have you had
it from
messy. Houston's? Have you had it from Houston's?
No, because I'm not a prime rib French dip
guy.
You
would love it. You would love it though. It's the best. It's like the pinnacle. It's the pinnacle of French dips.
But I would never order it. I would order a steak,
because I would tell you it's the pinnacle of French dips, and you would love it.
Nope. And because that's the problem, is I've already have it in my head that I want to order something else there. So I'm just.
Do you not like prime rib?
No, not really. I'm not against prime rib. I will eat it, but I prefer a ribeye or another cut of meat.
So here's the funny part. You realize, and you're right, and I feel the same way. I'm not a huge prime rib fan. I do love a ribeye. A ribeye and a prime rib are the same cut of meat.
That's fair to say.
It's just strange that one is delicious and the other one is it's all right.
Yeah. I like my meat grilled, and I don't know. Prime rib's not my thing. But anyhow, that's good to know though that it is the same meat, because I didn't know that.
Zofo follows up and tells us it's a Republican sandwich. So he's telling us his political affiliation based off of his sandwich, and he's saying you are not a Republican because you don't like them.
That I mean, do you know where I'm from? I mean, I don't know. Anyhow, let's answer some questions and dive into this. Josh, I have a problem with StreamYard. These people piss me off, dude. They send me this software that just literally is so hard to navigate. So first one we're going to talk about this evening, Josh. You're going to have to click on stuff and just go.
We need an important comment here. Miss Taylor makes the most important comment of the night, that she loved the intro song that Jeb spent weeks writing the music and the lyrics to, curating, compiling, editing, all that stuff. So Miss Taylor, we appreciate that, because Jeb spent a lot of time on it and we like it too.
There you go. We'll start with source. Just because it's something we just addressed, easy to come back to. So just when in July would rates get cut? So there's no guarantee that that's going to happen, but the Fed meeting is if and when the Fed funds rate could potentially get cut, and we just talked about what that means and the likelihood of that happening. So if you didn't hear that, go back about 5 minutes and listen to that. But Josh, do you know when the actual Fed meeting is?
Tuesday, July 29th, with an announcement finishing up in the announcement and press conference on Wednesday, July 30th.
Oh.
I was hoping that Wednesday was July 29th, Jeb, because that will be my 25th wedding anniversary. And it would be nice if Powell and the Fed rewarded me with the 25 basis point cut for my 25-year anniversary. But we'll see. We'll see what they do.
I like it. I like where your head's at. Marcus, are you seeing an increase in ARM loans due to lack of affordability? So Josh, do you have a lot of borrowers doing adjustable rates versus 30-year fixed?
Absolutely zero. And what I will tell you is we have lenders, two different lenders, United Wholesale, biggest lender in the country, at least for government loans, FHA and VA, they have been pushing ARMs. And kind of conflicting thoughts on that, because part of it, you say government loans are the riskiest loans, lowest down payment. Those people should be in a safer loan program. But the government ARMs have controlled margins, caps that are fairly safe. So don't hate the idea for the right borrower. I almost like it better than like a 2-1 buy down, something along those lines. What we see is the jumbo loans here more recently have, because they're generally held by banks versus sold into the secondary market, you'll see a bigger benefit there. I do have two of our investors that say July 1, they're getting very aggressive on their Fannie Freddie ARMs. And we'll see what that looks like. Because if you have a fix for 5 to 7 years, it's a pretty long time horizon, safe for most well-qualified borrowers. I'm not against it, but no, so far I'm not seeing it at all. But the lenders are coming up with solutions that have yet to be taken up by the consumer.
There you go. We've got a lot. We've got a couple in here saying that the sandwich is the business. So there's people out there that like it, Josh. There's people on board with you guys. I'm not against it. I just, not my thing.
Me, Jeb, I am asking who's being drafted.
Drafted.
It's the NBA draft tonight. Will you keep your head in the clouds, head in the
Bro,
sand?
who
What's going
watches
on?
the NBA? It is the sure.
If you knew what was going on with the NBA.
Dude, it's worthless. Like, why would I waste my time watching that? Ever since the whole COVID, like, let's play in a bubble. Like,
We're
no,
gonna have to start a new show with a more educated co-host.
I would probably, dude, you know how much I would appreciate that if you started a new show without me?
Relieve you of your responsibilities.
Please.
You see this? This guy doesn't even respect you. He doesn't want to show up here every Wednesday for you guys.
I have been showing up for 4 years, Josh, every Wednesday. Prior to you ever coming on, by the way. This show existed prior to you, just so we're clear.
Listen, you had rando co-hosts occasionally.
Thriving.
I was there for the inaugural.
Anshu says, is the Fed rate going to matter anyways? Bond yields don't correlate with Fed rate cuts lately. Not excited on these Fed rate cuts. What do you guys think? And thanks for the quality content as always. So we appreciate you on that front. Listen, any sort of cut is a good thing at the moment. Again, the policy is really restrictive. We talk about this a lot in today's episode that we recorded. That's going to be out, like Josh said, in 10 days or so. But listen, Fed policy is super restrictive right now. A Fed rate cut isn't going to do anything. 25 basis points is basically, it doesn't matter. But it starts heading in the right direction. So if they don't cut, it just means it takes longer to get to where we need to get.
So let's look at this. He's saying bond yields don't correlate with Fed rate cuts lately. Well, we had 3 cuts last year for a total of 100 basis points. And you have to look, the market front ran that. The market dropped rates well before those Fed cuts. So people say, well, see, the Fed cut and rates go up. Well, the market was watching what the Fed was watching. The Fed panics, the market panics a little, the Fed panics a little. They both get in line, and the Fed's not going to turn back around and hike rates, but the market can look at it and go, oh, just kidding. There wasn't actually a recession. The unemployment figures didn't skyrocket. Everything is okay. And then about that same time, late in the year, early first quarter, you see some hot inflation reads, and they're like, maybe we missed it. Maybe it's going the other direction. We had people calling for 6% Treasury yields in the first quarter of this this year. So it's easy to look back and go, something got out of whack or is not correlated. We have just had a difficult economy to read, both for markets and the Federal Reserve. So they are still restrictive at this point, depending on whose measure of the neutral rate you're looking at, anywhere from 50 to 150 basis points. And that is before the economy softens in a major way. Like there's some canaries in the coal mine where you're thinking it may happen, but the markets aren't yet really reacting to it because we've got bit like 3 times since 2022 with rates dropping and not following through. So I think we're going to have to see some sustained negativity in the economic news before you get a big move lower.
Agreed. Miguel, good question. Says closing next week, new construction. So congratulations on that. Had a home inspection done and found a couple issues. Should they be fixed, even if minor issues?
Through the home warranty after? No, I'm not going to use my insurance to fix something that the person that sold me something should have already handled.
Yeah, that should be done prior to the close of escrow by the builder. It shouldn't be done through a home warranty company. Home warranty companies typically don't fix issues that weren't working at closing, right? So if you have something that's wrong at closing on a property and then you close on it, the home warranty company, that's not their responsibility. Their responsibility is to fix issues once you close on it that were working prior to you, prior to them coming in and offering to fix them. So any issue with a property, especially on new construction, should be addressed prior to ever closing on that home. So if you have an agent, that's what your agents should be doing, putting a repair request together to make that happen. Josh, what are you doing over there?
I'm developing a little cramp here that I'm either going to turn the camera off or you're going to be going solo here for a second.
Bro, this is interesting. Like your whole arm went up and like this is like a whole thing. Are you guys seeing this?
I'm going to make you go solo.
That's fantastic.
Hold on, we got breaking news, and I know this is important to you. Cooper Flagg selected by the Mavericks with the first pick.
Cooper Flagg, there you go. Mavericks.
Shouldn't have been rewarded for their incompetence of giving all-stars to the Lakers.
Well, it didn't really help them, did it?
I'm still struggling over here, by the way, Jeb. I have no idea how I got this.
You got to stay on camera because it's definitely interesting for those watching.
Go away.
We don't have a lot of questions at the moment, so anybody watching this and watching you, I think, is probably getting a kick out of this whole thing. So it's anyhow. Now, if you have a question, is the time to put it in because there's not a lot of them. But do us a favor, if you find any value at all, make sure you hit the thumbs up. Consider subscribing to the channel. Again, we're still trying to educate and empower home buyers out there, and the best way to do that is you guys seeing the videos that pop up and clicking on them and watching them, right? That's the reason we're here, is to help guide you guys through this process. So if you'd be so kind and do that for us, we would appreciate it. Josh.
Me has another suggestion. Says, get sci-fi on here would be epic. What's a sci-fi?
Yeah, I thought you were going to come in and enlighten me with what that was when you said that, and I was no idea. We're going to be an NBA draft.
It's going to be an NBA draft show, or a why is Josh having a cramp that won't go away show here real quick. Like,
Josh, look at this guy standing up mid-show. Like,
we're going to do some stretching, trying to get this damn cramp gone.
What kind of episode are we going here? All right, guys. Questions. The home inspector guy. That dude. Yeah, I've seen some of his content. Home inspectors. Josh disappeared for me. He's gone. They're there to find problems, and he does find problems, but he also makes a big deal out of like everything, which can be a little much, right? I mean, real problems are problems and they should be pointed out, but everything is not a problem. And he's there to get content, get views. So, but his, some of his content's good, especially with all the new construction stuff. Josh disappeared on me, so I'm solo, as you can see here. So we're going to continue answering questions until Josh gets back in, telling him to eat a banana. All right. So what questions do we have? All right, here's one from Source. Can you explain transfer taxes in a simple way to understand? They are always so confusing on a loan estimate. So transfer taxes. So when you close on a property, you have a couple of different taxes, right? You have um, property taxes. Sometimes you have transfer taxes, that sort of thing. So transfer taxes and city taxes are something that are local taxes, and it's basically for you to become the homeowner. There's some sort of tax that's associated with it that gets charged, and essentially that's what you're paying. So I don't know what the actual rate on it is. I think it probably varies by area. Josh can jump into this when he gets back in. If he gets back in, he might be laying on the floor in his office at this point. But um, transfer taxes are basically that, and they're going to vary by where you're located. At least based on my experience. And then as far as property taxes go, property taxes get prorated at closing based off where you are in any given year. So, and depending on how much has, and if you're a seller and you've already paid taxes, then obviously you get a reimbursement, so on and so forth. So a lot of people get property taxes confused because of when the actual year starts here in Southern California. The fiscal year for property taxes starts July 1st and actually ends on June 30th. And so a lot of times there can be confusing. It can be very confusing on how property taxes get charged with regard to that. But that is something that your loan officer, your mortgage professional should be able to answer and guide you through when you're going through that process. All right. Let's see. Miguel, what cities in OC do you think will bottom in or boom in the next couple of years? I think it's probably the cities that are a little bit more affordable, some of the where their infrastructure is being built out, and they're doing different things to cities. Like Anaheim, for example, is going through a lot of changes, especially around with OC Vibe and near Angel Stadium and all of that infrastructure that's being built. To me, that's positive things for that area. And so over time, is it going to boom? All relative, but I think those are areas that you watch out for. It could see value add because of all of these things happening around it. I mean, that's one reason I felt like Huntington has done well over the last couple of years, is because a lot of the infrastructure, a lot of the shopping centers, a lot of that stuff was old. It was, built in the 60s and just hadn't been updated. Well, now we see, new restaurants, we see new buildings, new developments, that sort of thing happening, which again adds value here. But it's hard to say. Orange County is so built out. South Orange County's probably has the most opportunity for boom, just because there's more land out there. It's a little bit more affordable. And I think that's where a lot of people are likely going to head, because you get more bang for your buck. And because of that, you're probably going to see it reflected in values. West Side Costa Mesa was one that I thought would boom over the last couple of years, more so than most areas, because less building, and it's one that's done very, very well. And I think there's still opportunity in that market too. All right. Why is home ownership killing us in California? So home insurance rather. So home insurance is in the state of California is really weird. So for the last couple of years, prior to I think last year, the state put Josh is back. Josh is back. He's been doing stretches in his office. He's back.
We're gonna do a standing program.
Okay, that's all good. So, so before the last year or so, basically the state of California put a hold, if you will, on how much insurance companies could actually charge. And so for a while, they basically said, "Hey, listen, insurance companies, you can't change your premiums. Like you're capped out at where you are." And what happened was the state of California lifted that about a year ago, and a lot of insurance companies said, "Hey, listen, we're not going to do that again. So we're going to take it up to the max that we can actually take it up, because the state could put limits on us again." And so all of them increased it to the absolute max. And on top of that, you've had wildfires, you've had all of these additional things happen. And so what happens is a lot of these insurance companies aren't making money because of all of the wildfire and just different natural disasters that are happening out there. And so obviously when they can raise premiums, they're doing it. And, from the insurance side or the buyer side, it sucks because you're like, insurance is so expensive. It's jumped so much. These companies must be killing it. No, they're just making up for lost premiums over the last couple of years. And that's why a lot of them have left states like California.
Jeb, I don't think this is really our audience that feels this way, but this idea that government intervention fixes or solves things in California, we've had a situation where the state government said, hey, homeowner insurance is too expensive. We'll fix this. We just won't let these insurance companies charge enough. If a company can't make a profit, and this is funny, there will be someone that's watching this says, you're crazy. It's already been proven they make money hand over fist. If they can't sell their product profitably, they won't. I saw a headline yesterday, Jeb, that says New York City housing crisis is so bad, they're going to elect a socialist mayor. And you're like, the problem in New York City is 1,000 times worse because they think you can do the same thing with housing, that you can say, oh, we don't have enough housing. It's too expensive. Landlords, you need to eat this and subsidize every one of your tenants. And then what happens? People don't want to buy properties. They don't maintain properties. They just do the bare minimum because they can't profitably rent them. So I don't know exactly where the solution is, but government intervention of saying, hey, you can't price things fairly for the economy and make a profit on something is how you get to a situation where it's untenable. And we've definitely seen that in the insurance industry.
There you go. Derek says a recent report says 1/3 of student loan borrowers are delinquent. Will this have an impact on first-time home buyers? Will it? Could it? It could. As far as affordability and we know payments are now supposed to be made from student loans, and so now that that's added back into debt to income ratios, it could definitely impact what a buyer's able to afford and pay. As far as borrowers being delinquent on stuff, my question for that sort of thing is how many of those people are actual people looking to buy homes anyway? How many of those people are ready, able to buy homes? And of those, what's the real impact? Hard to say. It definitely will play a part, but everybody's making it out to be like, hey, listen, student loan debt is rising. These guys can't make their payments. They're going to have to foreclose on their homes. No, I don't think that's the case at this point. But impact, yes, but minimal probably.
Yeah, you would say, I've seen some people here with impacts to their credit scores that I didn't know that my student loans were starting up. The student loan stuff, Jeb, is all over the place. I see people talk to someone today, she go, I got like $4,000 or $5,000. And that's real money, but it's nothing. I have another listener here, $571,000 in student loans. And there's a plan there. They work for the government. They're in the public servant loan forgiveness program. They're in an IBR plan or repayment plan. So like the people that went about it intelligently said, okay, here's what it costs to get a degree that pays me this much. And here's my repayment plan, including if that just means I'm going to go work for the government for 10 years and they will pay this for me. But there are people out there who just didn't have a plan. I'm going to get whatever degree, I'm going to borrow whatever, sure, and I'll pay it back or I won't pay it. Those also happen to not be the type of people who have a plan for starting a family, building a career, buying a house. So there will absolutely be some overlap. I've seen some of it, but it's not in any major way because, as you said, it's not the people that are buying homes.
Good stuff. Heather says, thanks for your videos, Jeb. They are very informative. I appreciate you watching. Appreciate the support. Anybody that's here that's still watching my videos after a couple of years, I appreciate you. It takes a lot to be creative and continue to make content after the time that I've been doing it. I try very hard to change it up, and it's tough. It's tough. It's a grind, no doubt. Miguel says, to add to my new construction question, I meant to say repairs through warranty through the builder, not my home warranty. Yeah, you could use the warranty through the builder, but I would say, why close on a property that has issues? Like, fix the stuff before I close. It's that simple. Like, I'm not closing until the stuff gets fixed. This is your problem. That's their goal. And I know they have somebody, that's going to go through and blue tape the property or whatever, and they're going to come back and do it. But you've got a lot more leverage prior to closing than you do after closing. So I think you should use it then.
Jeb, apparently some people watch the show and they play a drinking game of some sort because Miguel says he's been watching you since 2020 when you predicted a crash. I was here in 2020. At no point has Mr. Jeb predicted a crash.
Jeb has never predicted a crash.
Interesting
In
recollection.
fact, all of the videos are still there, and I suggest everybody go watch them because I was one of the few YouTubers out there actually talking about home prices going up, inventory being low, just the whole idea of supply and demand. And I'm damn proud of that because I was pretty spot on that entire time. And actually going all the way back prior to the pandemic. I mean, my videos started in late 2019. Well, it actually started back in 2012. You can find those too. And
we have the receipts.
We have them. You should watch them. They're good. They're very good videos. They're the greatest videos. They're very good videos, Josh. The best videos. Tom says, what can a buyer do who is unrepresented prior to closing if there are issues with their new construction home? Refuse to sign paperwork, back out of the sale, claim on emergency leg grant.
That's a great idea. It works for me.
Here's the thing is when you're unrepresented, that's part of the problem is that you're dealing with the builder's representation. You just got to push back and say, listen, I want this done. I'm not going to move forward. Now, backing out is not probably going to get you anywhere. Backing out could lead to you losing your deposit. Remember, a builder uses their own contract. They're not using the state contracts in any of these scenarios, and their contracts favor them in all of these cases. So if you want things done, you need to stand up for yourself and say, hey, listen, and be tough about the process. Don't allow them to do things later. At least that would be my opinion. I would want it done. Unless you're confident or you have a relationship with someone there and you know it's going to happen. But even then, you're buying something new, right? I mean, would you drive a car off the lot that needed work before you bought it? I guess some people would, but the answer should be no.
Most wouldn't. That's probably the best example. Like if you show up and there's a giant dent in the side and they go, hey, just bring it back next week and we'll repair that. You're like, no, dude, repair it before I drive it off the lot. Then it's my problem. I got to bring it back. I got to take your loaner if you have it. I got to change my schedule. No, you get it right and then I will close.
Good. Let's see. We got a question here. What's going on with the market in Westchester County, New York? I am looking in Pound Ridge. Is that near Pound Town, Josh?
They're adjacent. They're adjacent communities.
But the houses are selling 24% over asking. It's impossible to win a bid. So I don't know anything about Westchester County, New York, but what I do know is that the Northeast is still dealing with a supply issue. Demand is still pretty high compared to supply, and therefore that was terrible.
You got to realize that Pound Ridge is the upper echelon area of Pound Town, so you're gonna have more demand.
You got to have more demand there. Anyhow, that was terrible, guys. And this is, I mean, after 5 years, you got to change things up. But yeah, impossible to win a bid. I bet it's tough. I mean, I'm hearing a lot of people say how tough that market is, and it's not just Westchester County. It is the whole Northeast as a whole. But yeah, I don't know what the solution's more inventory. But I don't know what is going to change that at the moment, because if rates go down, you got a bigger problem. I don't know. I think you just got to stick to your guns, not get caught up in the FOMO, and hopefully find the right house when it's the right time. Jay Holiday, any homeowner insurance companies you guys recommend? I looked at quotes and the company Lemonade had good prices. So I think Lemonade's one of those online companies. I typically like to go to a broker, somebody that can shop around, a lot like Josh, right? You go to Bank of America or Chase, whatever, you deal with their rates. You go to a broker like Josh can shop rates, including a lot of those companies and a lot of other companies. Insurance companies are the same way, right? You could go directly to, say, Mercury or Progressive, or you could go to a broker and they can shop Mercury, Progressive, all of these other companies. Now, there's obviously some companies in there that don't do business on the, I guess it would still be the wholesale side of insurance. So, but in my experience, those companies are more expensive anyway. But I would get a couple of quotes from a couple of different companies, try to compare. And at the end of the day, you want to go with a reputable company that if something happens, you're covered. So don't go too far out there. But I do know people are using Lemonade. So, I don't know anything about them. I can't vet them personally.
We have a lot of people use it. It's easy. They can get you a quote easily. Shockingly, Many insurance companies make it hard to get a quote. So it's easy to get a quote from Lemonade relative to some other sources. Don't know anything about the quality. And I don't know that they actually insure. Aren't they a marketplace, Jeb? They're going to connect you with an insurer. I could be wrong. It could truly be through Lemonade.
Oh,
Maybe I should do the research.
I don't know. I thought they were their own company. Like
Okay.
they're actually issuing insurance, but I could also be wrong. We did get confirmation it is next to Pound Town. So that's
good.
That's why. That's why.
High prices.
What do you think of modular homes off frame on land, Josh? Do you have any experience?
By off frame, do we mean not on permanently attached to
We
the
mean
foundation?
not on the frame.
Yeah, if it's not on the frame, it just levitates above the frame. I'm not
It's
sure
just
how
laying
that
on the
works.
ground.
No, it just levitates. It floats above the frame. Don't even know where we're going with that. So it is important. We get people asking all the time. I don't have a problem with modular homes. You have pre-1976, they're impossible to finance. So you want it to be newer. You want it to have a HUD tag. You want to have it permanently affixed to the foundation. But in general, not an issue with them as long as it's common to the area, meets your needs, and something you're going to be happy with.
All right. This is a good question, Mr. Josh. Do all mortgage brokers use the same lenders?
The shitty ones do. Well, it's a trick question. So there's the biggest wholesale lender in the country is actually the biggest lender in the country. So even when you include retail lenders, and they probably have 50% market share now. So the answer would have to be yes. Everyone uses them, other than brokers that they have kicked off of the channel. But 95% of brokers use them. Does that mean that we use them exclusively? At times they get really aggressive and they want to buy the market, and there's no reason to take the loan anywhere else. But for the most part, there's 5 to 7 major lenders that most everyone works with. We're approved with 70 different lenders. Once you get out of that top 5 to 7, it becomes pretty nichey from there. There's a reason why you're using those lenders. And we're talking, you have your core group of Fannie Freddie lenders, then you have your non-QM lenders. You have lenders that have specific niches. But for the most part, there's a lot of the same sources. It doesn't mean you have the same pricing, and you have a very different experience from broker to broker. What I will say is brokers are better for the borrowers, but a bad broker is more common than a bad direct lender or someone who works for an independent mortgage bank, because they're a bigger, more corporate structure, and they're not going to tolerate someone making their company look bad. Whereas someone can be the broker themselves and they can make themselves look as bad as possible, or they work for a broker that just doesn't supervise them and they're out there doing dumb things that hurt the reputation of the industry and the company. So the best broker is generally the best option. The average or worst broker may be worse than a direct lender.
All right. Question here saying, my friend is in contract for a new build, a 3-story house. It comes with a suite and a den on the first floor. She plans to add a kitchenette, laundry, and wall for a next-gen setup. Is this a good use of capital, and will it help with appraisal when she refinances down the road? She's putting 10% down. Here's the thing is I would try to find a comp of somebody that's done something similar and see what the value difference is. In theory, I mean, adding a kitchenette, adding laundry, does it add value? I mean, maybe. I don't know how much an appraiser is going to add to that. If it has a separate entrance and now it's its own unit in a property, I see more value in that. But just having a unit in the unit itself, and now it has a kitchenette and sort of thing, I don't know if there's much value in that. I mean, the value comes in somebody actually wanting that as a buyer. That's where the value is. The value isn't necessarily in the upgrade of itself. But even then, I would say, what's it costing to do that? You're probably going to get, I don't know, 20-30% of what's costing you to do in some sort of value add. But even then, it just, you got to have something to compare it to. And I don't know. It's one of those.
It could make it harder on resale or refinance.
Sure.
If they're needing to find comparables that also have an interior unit like that.
And you might find somebody that's looking to buy that down the road that doesn't want that. And they're like, why the hell did they put a kitchenette and the laundry in here? Like, it changed the whole floor plan. I don't like it. So it's one of those more taste specific things, like what somebody's looking for. I do see an opportunity for it to add value. I can't tell you whether it does or not. How's a 2.5% interest rate looking for 2026, Josh?
The outlook for 2.5% rates in 2026 is a little hazy, a little doubtful, a little unlikely. But anything's possible. We could, the thing in Iran could stretch out and be bigger. And by the way, people get really mad when you say Iran. Apparently it's Iran. And if you say Iran, you did it wrong.
That's like Kamala.
It is.
Or
it is.
what
Except
was
for
the
I
other
don't
one?
ever, I'm pretty sure Iran is the right way. So if you're going to say it, go that route and there will be less people yelling at you.
There you go. Well, we got hate when I think I pronounced her name Kamala. Which is it? I don't even remember.
I think it's Kamala, like Kamala.
Kamala.
Like C-O-M-A.
There you go.
That's
Yeah,
the
I
correct
said
way.
Kamala, and dude, people like hate melt me, and I'm
Don't
like,
do
dude,
it.
I just don't know how to say her name. Like, what are we
Exactly.
talking about
It's
here?
a unique name.
People
I was
mispronounce
not
my name all the time. I don't yell at them.
Yeb. They call you Yeb.
Dude, I get called Jeff, Jim,
Jeff. I have many people referencing. I've been watching Jeff's videos. I'm like, I don't know Jeff, but his videos sound amazing.
I don't get mad at anyone for it. It's all good.
Jeb, hold on. We have more breaking news. Con Knipple to the Charlotte Hornets with pick number 4. Con Knipple.
All right. I don't know who that is. That's fantastic. That's great.
Because he's from Duke, and you act like guys from Duke don't exist. That's 2 out of the top 4 coming from Duke. I haven't seen any Tar Heels picked yet.
Well, because the Tar Heels had a garbage team last year. Cooper Flagg was he was a good choice. He was a good. But I'll tell you, Duke players going to the NBA. Wait, you got a couple Grant Hill. Like who's actually done something in the NBA from Duke?
Carlos Boozer.
Jesus.
Cherokee Parks.
The only reason you know his name is because he played for the Clippers.
Carlos Boozer never played for the Clippers, bro.
He didn't? Who did he play for?
Who knows? The Cleveland Cavaliers, until he hoodwinked them to rescinding his contract.
Right. He was
so he could sign for more. Yes.
All right. Let's see. What costs more in Southern California, the land or the structure? I'm trying to understand why insurance companies charge so much premiums if the land is probably worth more than the structure. So the land is valuable, but the structure of the home is probably where the majority of the value is being added in most of these areas at the moment. If you look the breakdown on taxes, land value is typically less.
Well, let's look at my house, Jeb. Sure. The rebuild cost will be less than $600,000, and the value is close to triple that. So the land, and again, it's.
Do you think you could build your house for less than $600,000 in this market?
It's 1,700 square feet. That's $300 a foot. Yeah, I can build that house really nicely for $300.
All right. These people are crazy right now. I don't know that you can.
Yeah.
You might be able to do it with a hammer and some nails, but I don't know that you're going to find a reputable builder.
I have a really good tool belt and a nice bench of tools, so I could probably do it in a weekend or so.
That's crazy. I bet if you tried to redo the inside of your house entirely, you'd spend like $300,000.
But just think of this, Jeb. So here's an interesting look at this. I watched a video Realtor did up in the Palisades where he took a guy who's a developer that buys old houses, dozes them, and builds McMansions and resells them. And they literally lost one the day, put it on the market the day before the fires and lost it in the fires. And he was walking through, he goes, we have to rebuild this and sell it because I paid $2.7 million for the lot with the house on it. And now with no house, it's worth about $1.8 million. So there's value in that home and probably more than there should be. But from that perspective, that is a very high-end area, higher-end neighborhood than mine. And if you're right by the beach, again, it just the value of that. Southern California is a big area. You can go to other areas where maybe it's 60% structure, 40% house. Some areas that are really highly in demand, the land is what's in demand. That location, it could be 3 times what the structure value is.
Yeah, I mean, and another reason the premiums are high is just because the premiums are high, right? I mean, because they can. When competition is charging X amount, you can also charge X amount. Because you don't, everybody else is doing it. Nobody out there is undercutting the market just because of the potential liability. I mean, they're doing more things now with insurance than I've ever seen. I mean, I think I told you, Josh, recently, a buddy of mine reached out to me and said, the insurance premium on his mom's house was due for renewal. And he called me and he goes, hey, you have an appraiser you recommend? And I'm like, yeah, what's it for? He goes, the insurance company wants my mom to get a home. It was a home inspection, not an appraisal. Wants my mom to get a home inspection prior to them renewing the insurance. I'm like, what are you talking about? And then working with buyers right now, they want to know how old is the roof? How old is the plumbing? How old is the electrical? All of these things are being factored in now, whether or not an insurance company is willing to actually even give you insurance on a property. So that whole world is crazy at the moment. And unfortunately, I don't see a lot of changes happening in the foreseeable future with regards to premiums and or the craziness surrounding it. Josh, is San Clemente the most affordable beach city in Orange County? Huntington Beach used to be the most affordable beach city in Orange County, and
Dana Point has always been a little bit cheaper, but Dana Point, Huntington, San Clemente would probably be your three that would be the cheapest.
Yeah, I still think. I mean, it depends on what you're trying to buy, right? I mean, if you're trying to buy a single family home, half a mile to the beach, it's going to vary, right? If you're willing to go, I mean, Huntington Beach has more inland areas than probably either of those. So the further inland you go, the less expensive it's going to get, and you're going to get more bang for your buck. So you're probably going to get more house in Huntington further away from the beach than you're probably going to get in those areas for a similar price point. But it's going to be very comparable, very comparable. Is it comparable or comparable, Josh?
It just depends on what part of the country you're from. From Kinston, what is it?
Comparable.
It's comparable in Huntington Beach.
It's comparable in Huntington. So is it progress or progress?
It's progress everywhere that civilized humans exist.
Well, all the English speaking people, the Brits,
Canadians will say progress.
I can't argue it though. When you sound it out, it should be progress. Just saying. If somebody buys a house at today's rate, would you take a lender credit for a higher rate and bet on refi within the next 2.5 years, or take the lower rate and waive the lender credits? Josh,
have this conversation, but generally the flip side, rates are elevated, right? So no one wants a higher rate. It is pretty rare that someone says, hey, give me a 0.25% higher rate and give me 1% in lender credits. So the question that we get more often is, do I take a 0 point, not pay anything and just pay my own closing costs? Or had this conversation with a San Diego borrower this morning, looking at about 1.5 million purchase. And they're saying, we want that payment as low as possible. So show us options with multiple points. I said, okay, just understand that what you're saying, it's a sunk cost. It's a sunk cost with about a 5.5, 6 year break even. So if you move or sell the house or refinance within that time, you're not going to get a chance to recoup it. So I said, let's look at the 0 point options in addition. And you tell me what's the right answer for you and your family based off of what you believe is going to happen with rates. I think we're going to have an opportunity for 6, 5.5, 5.25 sometime in the next 3 to 4 years. So I don't want to pay a bunch of points to get a lower rate today.
Good stuff. If you've found any value tonight, make sure you hit that thumbs up. Consider subscribing to the channel if you haven't done so already. If you'd like to speak with Josh, go through the pre-approval process. You want a second quote on whatever you're getting quoted now. There's a link scrolling in the bottom of the channel, jebsmith.net/start. I can actually refer you to an agent in your market as well. In fact, we've referred 3 to 4 people in the last 24 hours. Yeah.
Yes.
So happy to connect you. I mean, we got one just connected in Boston, one in Houston, one in Palmdale. Was that the 3? That was there a 4th? That 3. So 3 people in the last 24 hours. So if you need to be connected, you can use that same link. But until next week, guys, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.